Right now, half of the internet screaming that AI is the biggest bubble in history, the other half screaming that it's the biggest breakthrough since sliced bread. And honestly, both of them are watching the wrong thing entirely. Everyone in this fight is arguing about the same thing. User growth, adoption, revenue, they're all just arguing about demand. But demand is the side of the coin that can lie to you. It's noisy. It's a story that changes depending on who's telling it and what they're trying to sell you. But every coin has two sides. And the other side, the one nobody's talking about, paints a much better picture of what's actually unfolding. It's what the world's best investors have quietly used to track financial bubbles for more than 200 years. And it starts by looking at the other side of the coin, supply, because demand can be faked. But you can't fake supply. Supply takes real capital, committed upfront, and it tells the real story of what's happening. This year alone, the biggest tech companies in the world are on track to spend around $725 billion on artificial intelligence. That breaks down to roughly $2 billion a day, or about $23,000 every second. We've never seen a bubble of this size before, but as Mark Twain put it, history doesn't repeat itself, but it often rhymes. And the real question isn't whether AI is going to change the world. Financial bubbles aren't built on bad technology. Most of the time, it's the opposite. ResearchGate looked at 175 years of major breakthroughs and found that 37 of 51 major breakthroughs in technology triggered a massive speculative financial bubble. As billionaire investor George Soros said, stock market bubbles don't grow out of thin air. They have a solid basis in reality, but reality is distorted by a misconception. Which is why the best investors have stopped watching demand and started watching supply. Because when you follow the paper trail, you get to the truth. It starts with a framework rooted in some of the oldest ideas in economics, going all the way back to Adam Smith in the 1700s. The increase of stock, which raises wages, tends to lower profit. When the stocks of many rich merchants are turned into the same trade, their mutual competition naturally tends to lower its profit. Translate this out of 1700s powdered wig talk, and what Adam Smith is really saying is that money flows into industries with high perceived returns, which means more competition enters, which drives returns down for everyone. This idea has been modernized into a framework called the capital cycle theory, and it moves through an industry in 4 steps. First, the flood. A new technology shows up, the returns look sexy, and capital pours in to chase them. Step 2, the boom. Competitors pile in faster than demand can grow, and the more everyone builds, the more returns start to slip. Step 3, the collapse. All that new supply crushes the very returns that attracted it in the first place. Prices fall, companies fail, and a lot of people lose a lot of money. And finally, the inheritance. This is where the real money gets made. Capital flees, the builders go bankrupt, and somebody walks into the wreckage and buys the assets for pennies on the dollar. Take yourself back to the 1830s. The first industrial revolution is in full swing in Britain, and mines and factories need to move coal and iron faster than horse-drawn wagons allow. Then new railway technology shows up and changes everything, and where excitement is, the money follows. This is the flood. Capital poured into anything with the word railway attached to it. And not just from bankers, shopkeepers, clergymen, widows too. All of them piled into railway stocks because nobody wanted to be the one who missed out on getting rich. At its peak, railway investment hit around 7% of the entire British economy. In a single year, Parliament passed 272 separate acts just to authorize new lines. Then came the boom. Companies stopped building the railways the country needed and started building whatever they thought would push their share price up. Routes got duplicated, lines got run out to villages that would never fill a single train. Then a reality check came when the new lines were bringing in only about a quarter of the revenue investors had been promised. By 1850, the collapse was in full effect, and railway shares were worth less than half their peak. Fortunes that had felt permanent were simply gone. And then the inheritance. The rails were still sitting in the ground, and over the following decades, that network became the backbone of the entire British industrial economy. The people who got rich were the ones who scooped those assets up for pennies after the bubble burst. But while top hats and mutton chops make it easy to dismiss this as a Victorian problem, that couldn't be farther from the truth. Jump to the late 90s after the US rewrote its telecom laws in 1996, and the flood poured into fiber optic cable. Carriers buried more than $500 billion of it, around 80 million miles, across the country and under the oceans. Then reality caught up. Around 85% of that fiber sat completely unused. Bandwidth prices fell about 90%. The Nasdaq fell more than 70%. And Corning, one of the largest fiber makers in the world, watched its stock fall from over $100 a share to about $1. Funny enough, Corning has become one of the hottest names in AI right now, and their stock chart looks awfully similar today to how it looked back then. A decade later, the same pattern hit oil. Innovations in fracking unlocked massive, previously inaccessible reserves. Capital flooded in, drillers came chasing all at once, and the U.S. became the largest oil producer on Earth. Then supply blew straight past demand. Between 2014 and 2016, oil collapsed from over $100 a barrel to about $30, and more than 200 North American oil and gas companies went bankrupt. Railway mania, fiber optic cable, shale. 3 different centuries, 3 different technologies, nothing in common, except the exact same cycle underneath all of it. Which brings us to the biggest one yet: artificial intelligence. This is the one that matters most because artificial intelligence right now is holding up the entire economy. A Harvard economist named Jason Furman found that AI investment was only about 4% of GDP in early 2025, but it accounted for roughly 92% of all U.S. economic growth. Strip AI out of the equation, and the economy only grew 0.1%. So where does AI sit in the capital cycle? The money is still pouring in, but if you look closely, there are cracks starting to show. In the 90s, they faked demand with a story. WorldCom claimed internet traffic was doubling every 100 days, and it was never real. This time, they're not faking it with a story. They're faking it with money. You've probably seen the chart that looks like a circuit board, where every arrow is money moving between the biggest names in AI. NVIDIA funds OpenAI. OpenAI pays Oracle. Oracle buys NVIDIA chips. The money makes its rounds and comes home to NVIDIA, and every time it passes a hand, it gets counted again as brand new demand. The fiber bubble ran the same trick. Equipment makers like Lucent and Nortel lent their own customers the money to buy their gear, then booked it as revenue. Activist hedge fund Buxton Helmsley clocked this immediately, noting that vendor financing didn't merely add risk at the margin, it manufactured the appearance of end demand and supported valuations until the moment the sellers could no longer extend credit. But there's one thing that Circle can't do. It can't escape what Adam Smith laid out: money chasing high returns, competition entering, and returns compressing for everyone. The best place to see returns slipping is OpenAI itself. 2 years ago, OpenAI basically was AI. Then Google, Anthropic, Meta, and a dozen others showed up selling the same thing. Last year, OpenAI's financials leaked, and it's ugly. OpenAI lost $38.5 billion in 2025, nearly 8 times its loss the year before. Sales and marketing spend jumped over 400% to $5.7 billion, 44% of their entire revenue, just to keep people using the product. We're already seeing the signals. In early June, chipmaker Broadcom beat its earnings but guided its AI sales slightly lower. For a nearly $2 trillion company, that should barely move the needle. Instead, about $300 billion of its market value vanished in a single session. That's the tell. When soft guidance can erase $300 billion in a day, you're looking at a market priced for perfection. There's an old line in business: the pioneers get the arrows and the settlers get the land. In the mid-90s, AltaVista, Lycos, and Excite spent millions building the first search engines, then let the product decay chasing revenue. Google walked in and took the land. Before Uber and Lyft, a company called Sidecar fought the legal battles that made rideshare possible, and while it bled cash in court, Uber and Lyft copied the model and took over the world. Most people are focused on the demand side, arguing about whether the AI boom is real, and that's understandable, because demand makes for a great story. But in finance, the biggest outcomes are rarely driven by the loud headlines. They're driven by the quiet mechanics underneath. If you want to understand what's really moving the market, instead of just following the noise, hit subscribe.